Hey, welcome back. Today we are going to see about the Palantir. The ticket is PLTR. This stock just put up one of the strongest quarter on any large cap software company this year, and it's still down sharply year to date. The gap between greatest business and falling stock is exactly what we are going to dig into. Over the next 10 minutes, I want to walk through the actual numbers, run it through my own quality framework, check the chart, and land on a real verdict. Not just a hype, it's a kind of a direction. Let's get into it. Let's see the scene first. Let's first set up this like a snapshot. Currently, PLTR is trading around $129 a share right now, which puts the market cap at roughly 315 billion. Here's the context that actually matters. This stock is down about 27% year to date in 2026, and it's still sitting well off its 52-week high of just over 207. So the real quick question isn't it whether Palantir is a good company? By most measures, it clearly is. The question is whether the price has actually caught up within the pullback or whether there is still more room to fall. That's what we are here to figure out. This is a quick refresher on the business because this matters for the bull and bear case strategy. Palantir runs three core platforms. Gotham is the original product built for defense and intelligence work. Foundry is the enterprise version, basically an operating system that pulls all of the company's data into one place so it can actually be acted on. And then AIP platform is the newest piece. It lets organizations run large language models directly against their real operation data, not just a chatbot bolted on the side. On the customer side, Palantir splits into two segments: government, that is the original base, and then a commercial, the newer one. This is fast-paced, growing piece that the market has been watching closely to see if it's actually real. So here, the headlines number for Q1 2026, so which came in at $1.63 billion, up 85% year over year. And that growth rate is accelerating, not slowing down. Compare that to Q4 last year, which grew 70%, and you can see the trend line is actually bending upward. That's rare at this size. Break it down further. US revenue overall grew 104%, crossing the 100% mark for the first time ever. And the US commercial, the segment skeptical said could never scale, grew 130% year over year. This wasn't a soft beat, it's beat past consensus. Now, here, what separates this from a typical hyper growth story? Palantir is genuinely profitable, and the profitability is scaling right alongside the growth. GAAP net income was $871 million for the quarter, and 50% net margin, 53% net margin. That's exceptional for any software company, let alone one grow this fast. Adjusted free cash flow was $925 million, a 57% margin. There's a metric investors use called Rule of 40. You can add the growth rate to the profit margin and it clears 40%. The business is considered healthy. So Palantir's score is 140%. That's not a typo. That's roughly 3.5 times the bar for healthy. All right. So let's look into the balance sheet because this is the part of my own screening process. Here, Palantir is sitting on $8 billion in cash, equivalent and short-term treasuries. So total debt also is basically negligible. The debt to equity ratio is around 0.02. My own rule is I want the number under zero point 0.5 for the quality screen for the debt. Palantir, isn't it just clearing the bar? It's nearly zero. That matters because it means this growth isn't it being funded with leverage. If the market turns, this company isn't it sitting on a liquidity time bomb the way a lot of growth names would be. Next, going on to the guidance raised, and it's not just the quarter that impressed. Management raised full year guidance right on the back of it. Full year 2026 revenue guidance is now 70.65 to 70.6 billion dollars, about 71% year over year growth, roughly 10% point higher than the midpoint of the prior guidance. They also raised US commercial guidance to north of 120% growth and bumped full year free cash flow guidance up to 4.2 to 4.4 billions. When a management team raises guidance this aggressively right after a beat, that's usually a signal they are seeing real demand, not just one quarter pop. Next, moving on to the bull case. Revenue growth is accelerating, not slowing, even off an already large base. The company is genuinely profitable, 50%, 53% net margin, 57% free cash flow margin. The balance sheet is about as clean as it gets. Management just raised guidance aggressively, telling you they are confident in the pipeline. Government relationships keep expanding too. There is a new UK Ministry of Defence contract worth over 240 million pounds, and the Fed Start program keeps adding partners. And despite the pullback, Wall Street is still mostly bullish. The average analyst rating sits in the 185 to 195 range, with some calls as high as 225 to 255. Now, the other side, because one sided take isn't useful to anyone, here the valuation is still rich. About 145 times trailing earnings, and even adjusting for growth, the PEG ratio sits just above 1.5, which is the line I personally get cautious about. Momentum has cooled. The stock is trading below its 200-day moving average, telling the long-term trend is still working through a correction, not confirming an uptrend. Not every analyst is on the board either. HSBC actually cut their target from 205 down to 151, citing rising competition in AI software. And there is a real world risk most software companies don't carry. Palantir reportedly lost a legal challenge in Switzerland tied to government contract work, a reminder that political and regulatory exposure is part of owning this name. On top of all that, the beta is around 1.5, meaning the stock moves harder than market in both directions. All right. So this is about my quality framework. Here where I actually apply my own checklist, the same one I run on every stock before I even glance at a chart. So 6 criteria: revenue growth above 10%, EPS growth above 5%, 15%, return on equity above 15%, debt to equity under 0.5, positive free cash flow, and a PEG ratio under 1.5. So Palantir clears 5 of these 6 with room to spare. Revenue growth in the 70s to 80s, EPS growth and UPS growth around 42% over year, return on equity in the 30s to 40s, almost no debt, nearly $1 billion of free cash flow in a single quarter. The one box it doesn't tick in the PG that doesn't tick is like the PG ratio. So it's sitting around 1.6, just over my 1.5 line, and honestly, that's the entire debate around this stock in one number. The business is excellent, but the market is still pricing a lot of future growth that has to actually grow up or show up. All right, let's check the chart because the fundamentals only tell you whether we want the stock or chart helps when it like when to get into it. Right now, PLTR is trading below its 200-day moving average, and even after it recent bounce, which tells you the long-term trend is still in a corrective phase. It is trending above its shorter 20, 50, and 100-day averages. So there is some short-term strength here, but the momentum reading has seen sitting in the film stretched territory rather than oversold zone. For anyone following my usual approach, waiting for a monthly oversold signal following by a confirmation of a candle, the signal simply is not yet available. So like this read mostly like a stock cooling off period from sharp run than once that's actually bottomed. So we have to wait for this one and get a confirmation. And going on to my verdict, the business itself is genuinely excellent. Growth acceleration, profitability real, and scaling. Balance sheet about as clean as it gets. Management keeps raising the bar, but the price hasn't fully got down to where that growth has reasonably valued. The PEG ratio and the charts are both telling the same story, not yet. So we have to wait. My move here. All right. So my move here is to keep this one on the watch list and track it closely, but not chase the bounce. I would rather wait either a clean technical entry, that oversold signal I mentioned, or a genuine validation reset, than like buying it now in this correction phase. So it's a strong business, just not my price. I just need to wait for perfect execution. All right. Um, a quick disclaimer before we close out, this is not a financial advice. It's my own read on publicly available numbers, run through my own personal framework, and you should always do your own research and talk to a licensed financial advisor before making any decisions. If the video is helping, you cut through the noise on Palantir. Like I hope that helped on that. And do like, subscribe for more breakdowns just like this one, or let me know if any other stocks to be discussed. And yeah, thanks for watching. I'll see you in the next one.